Cool. Thank you so much, Elle. Hope everyone's doing well. Thank you guys for coming out tonight. I'm sure you guys have finals to study for, but I appreciate you guys coming out. So go ahead and get started. All right. So like Elle mentioned, I'm a Mason alum. I was there from 2017 to 2021. I was actually a kinesiology major, so like exercise science, but kind of graduated and drifted to more the corporate world in financial planning. So yeah. Just a quick kind of disclaimer before we get started. All this is purely educational, kind of general information. If you want more tailored information to your specific situation, definitely go find someone who is certified, and I'll talk about all the certifications later. But yeah, just none of this is actually official financial advice. So don't take any of this to heart. Don't go sell off investments just from this information. So kind of like I said, I was a Mason alumni. I was from 2017 2021. I'm in the middle of the shortest guy. I was on the club team for 2 years and then was the head coach of the club team. Then went on to be the head coach of a few other teams kind of in the area. So we're doing financial planning. So what is a financial plan? According to Investopedia, it is a document containing a person's current money situation and long-term monetary goals, as well as strategies to achieve those goals. So financial planning is basically you have your school schedule that you get on Blackboard. It's like that, but for your whole life in terms of everything money. So mortgages, investments, taxes, all that fun stuff. Also, kind of side note, if anyone has any questions, feel free to just kind of interject. I can't answer anything tailored to your specific situation, but I can clarify anything or answer any questions anyone has. So next, what does a financial planner do? First off, it is portfolio management. So everyone or each couple kind of has their own portfolio of investments, whether that be stocks, bonds, futures, options, various securities. So we help manage that. We help kind of regulate and look over any kind of insurances that you have, whether it be car insurance, health insurance, life insurance. Life insurance is kind of well known to be a good tax strategy to avoid paying taxes within the financial world. And then kind of going on to taxes, making sure your tax serving filed, making sure we're avoiding any taxes that you don't have to pay. And then finally, kind of estate or retirement planning. So working on different strategies for taking Social Security, different benefits for spouses, and figuring out kind of what goes in a will, that kind of thing. Has anyone seen the Wolf of Wall Street? You guys can say, okay, cool. So for those who know, The Wolf of Wall Street is a movie based on Jordan Belfort. He was a stockbroker. The point is, he is not a financial planner. So that movie, there's a very big distinction between kind of broker-dealer firms and financial planners. Financial planners are fiduciaries, as in they have a responsibility to do what's best for the client. These two guys are not fiduciaries. They purely sell securities and different products to make a commission off that. So it's kind of there's a big difference. Let me see. So someone said, if you don't get health insurance at a certain age or time, does the government take money out of your Social Security when you retire? Yes and no. You can use Social Security to fund your health insurance, if that makes sense. But yes, and there's some portion of Medicare that is kind of funded by Social Security, if that makes any sense. So there's a few different types of financial advisors. You have the chartered financial analysts. So those are kind of more your stock pickers, your quant traders, the ones who kind of build the portfolios. Then you have your certified financial planners. Those are more kind of finding out strategies to help you retire with the funds that you have available, kind of the best strategies to for taxes and kind of overall investments. And then you have your certified public accountants. Those are kind of more your CPAs, your the people who file your taxes, and they're not usually they don't usually do the investment management like financial planners and the analysts do. But again, they're more on the tax side. So just kind of going over some general advice that most financial planners will give you. So first off, talk about setting goals, controlling your spending, managing your savings, paying off debt, and then investing, kind of the fun part. So I'm sure all of you guys have seen this in class, kind of the SMART goals. It's when you set a goal, it should be specific, measurable, achievable, realistic, and timely. Obviously, if you have $5 in your bank account, you can't buy a house. Just kind of being realistic. But yeah, you guys kind of know that chart, so I won't spend too much time. Second piece of advice is just controlling your spending. Really kind of watch what's going in and out of your bank account. According to a study done by Fidelity back in 2021, about 50% of Americans don't look at their bank account. My girlfriend is very guilty of this. She doesn't really check it every week or even month, which I would suggest doing. I'm kind of crazy. I check my accounts every day, just kind of make sure nothing crazy is happening. But overall, in terms of spending, kind of the go-to percentages are you want 50% of your monthly income to go to needs, as in rent, food, gas, all that, 20% into savings, and then 30% into wants. The more of that goes into savings, kind of the better off you are. Kind of same concept is kind of managing your savings. The more savings you have, the kind of the less stressed you are. Again, generally most planners and financial advisors recommend 3 to 6 months of living expenses saved up. And then that's just in case for a job loss, you want to get a new car, there's damages to your house, any kind of emergency that comes up that you need kind of fast cash for. And then you have kind of paying off your debts. That's not a good thing. The average college student has about $37,000 of debt. So you guys aren't alone. I still have debt that I'm paying off. And then kind of a popular method, if you guys know who Dave Ramsey is, he's kind of big finance YouTuber. He uses kind of or preaches kind of the snowball method, which is paying off the smallest debt you have and just kind of slowly kind of building your way to paying off that big debt. So say you have a Mason parking ticket that's for $35, and then you have your student debt for $40,000. You want to pay that small portion off first, then kind of work your way up to the kind of the bigger debt that you owe. Question. And then kind of the fun part, which is investing. I believe there was another speech or kind of seminar on investing. Is that correct, Elle?
What was the question?
Was there another? There was another seminar on investing, right? Or was this?
Earlier today, I believe there was one.
Cool. Okay, I don't want to. I'll spend too much time on it, just so because I believe that was already covered. But with those savings and that extra cash you have, you want to invest in appreciating assets. That involves stocks, bonds, any type of security. Real estate's a good one. Clothes, cars are example of depreciating assets. As soon as you buy a new car and it hits the road, it's a depreciating asset. The value of it goes down. Same with clothes, same with any kind of material good that has no potential to grow in value. So the earlier you are to investing, the better. You kind of see this chart. Someone who starts at 20 years old and contributes $50 a month can make upwards to 200,000. And kind of, as you can see, the later you start, the less you can make. So the principle of compounding interest really has a big impact. So again, the earlier you start, the better. And then we'll kind of take a look at the S&P 500 as of December 30th of last year. For those who don't know, the S&P is kind of a indice of the top 500 companies in the US. And this year it's been down about 20%, more about 25%. So it's been kind of a rough year for investors. But when you take a look at the overall picture from the very start of it, you see a very clear uptrend. So if you kind of see where we are right now, it's pretty cheap for everyone. So it's a really, really good time to invest because you're kind of buying everything cheaper, waiting for it to go up in value. And then there are a few kind of different investment strategies that advisors and planners use. There's kind of the buy and hold strategy where you buy just kind of index funds and mutual funds and kind of wait for them to grow over time and just kind of hold. And that works over decades. You'll definitely increase your net worth over decades, but there are other advisors who kind of like the more active strategies. So at Sovereign, we are kind of actively trading, buying and selling different securities to hedge against inflation and kind of essentially beat the market and try to time those downturns so our clients don't kind of have to suffer through it. If you can kind of see that big drop in the beginning, that was COVID, and then the market recovered really quickly. We had a good probably 4 or 5 years of a nice bull run, and then right at the top where the trend breaks, you can kind of see a funnel going downhill kind of starts. And this is just kind of very simple technical analysis that a lot of planners and analysts use to analyze the market and kind of control their portfolios. And then kind of as you see the far left, we're starting to kind of break out of that funnel. So hopefully things are looking better, but everything's so kind of crazy right now with all the bank situations. It's kind of scary, to be honest. So 401ks and 403bs, for those who don't know, these were created to help individuals save for retirement. If you guys don't know how those work, your company will match your contributions to it. So it's essentially your own individual portfolio, and they usually invest in index funds or mutual funds that are fairly conservative, and you'll match or put a percentage of your salary into that plan, and then your company will match it a percentage of it, whether it be 100% or 50%. And essentially it's free money for those who invest in these plans. So you definitely want to take advantage of it and max out your 401k or 403b. So for those who kind of know that term, that's putting as much money as you can in that the plan allows you, so that your the company you work for will match that, give you the same amount of money in that plan depending on their kind of match percentage. 401ks are kind of for-profit companies, 403bs are nonprofit. These plans are traditional IRAs, individual retirement accounts. So when you pull them out, the money that goes in is pre-tax, and then when you take distributions from those plans, you will be taxed on those distributions. Roth IRAs are again, same, our individual retirement accounts where it is post-tax money. So it's the money that you get as a salary that's been already been taxed. You put that into that account, it grows tax-free, and then you can take it out tax-free. Both these plans, you cannot take distributions from until 59 and a half. So say you have $1 million, but you're only 45. If you try to take that out, you'll suffer I believe a 10% penalty plus another percent penalty depending on your age and how long you've been with the company. Just kind of a little bit about my kind of financial journey. I don't want to come across as boastful at all. I just want to kind of show you guys that it's possible and kind of the benefits of investing and kind of that it's possible for you guys to kind of come out of college with a good start. So like I kind of mentioned, I was a kinesiology major. I knew nothing about finance, but through college, I lived very cheap. I lived with roommates. I limited my spending and I had 4 jobs, all from sophomore year up until now. And I was able to save about $150,000 that I just kind of have in liquid. And again, I don't want to come across as boastful. This is just kind of to show you guys that it is possible and it is kind of possible to start off your careers after college with kind of a nice nest egg when you're starting your careers. And then kind of looking at my investments between that roughly 150,000, I have about 60,000 in my investments, and then the rest is just kind of cash in a high yield savings account. There's various equations you can use to kind of calculate your estimated returns, but roughly if we kind of mentioned the 59 and a half, so I calculated to age 60 for the next 37 years. If the S&P averages about a 10% return and I keep investing $2,000 a month into that account, ideally it would grow to 10.2 million by the age of 60, which would be a nice kind of retirement egg. But this is not considered inflation. That's a whole nother topic that could take another 3 hours to go over. So what are the benefits of having a financial planner? As you guys know, having a financial planner it's not free. There's various different kind of fees that planners and advisors will use, but overall it's a benefit. It's for you to do the investing, the strategizing yourself. It's a full-time job, and as you guys are starting or in your careers and kind of worrying about buying a house or just too busy at your job, it would benefit everyone to have someone who's working on it full time and managing it full time, kind of your retirement. It provides kind of emotional guardrails. A lot of people are very emotional when it comes to investing, and so you kind of want that anchor as a planner or advisor to reassure you it's going to be okay, kind of like a coach. And then there's a lot of kind of little tax loopholes that planners and advisors can use to kind of save you some money and not have to pay those taxes. And then kind of like I mentioned, it's a full-time job, kind of monitoring the markets and various kind of financial affairs. So that's why you have planners and advisors who can really do that. And that's their job, to help you manage that, so you don't have to worry about it essentially. So yeah, that's it. Short slide, but thank you guys for attending. Does anyone have any questions that they kind of want to unmute themselves and say? I see the chat has a few questions. See. Keep paying student. Sophia, can you emphasize what legislative limbo is?
Specifically, the student loan debt repayment by the government.
Oh, gotcha. Depending on your kind of interest rate of that debt, I would keep paying it off. I wouldn't bet or I would consider the worst, and the worst being they don't pay that off. So I would keep paying it off so that that interest doesn't build and you just have to pay more in the future, if that makes any sense.
Yeah, that makes sense. I was just wondering because right now it's on freeze, so there's not any interest accumulating.
Oh, it is? Okay. I would still keep paying it off just in case they unfreeze that. Because you just don't want to hold on to kind of that kind of debt for an extended period of time, because we have no idea when they're gonna unfreeze it or pay it off or kind of make the decision to pay it off.
Got it. Thank you.
Yeah, of course. Lydia, you said, do you have any personal recommendations for beginners for investing? Can you elaborate on that?
I believe Lydia left. I don't see
Lydia?
her.
Okay, thank you.
It looks like Lydia may have added like
Oh,
any
any
books
books?
that you
Okay.
could recommend or something like that.
Sure, there's oh shoot. It's off the top of my head. I will send it to Elle and she can kind of send out the book. It's on my desk. I forgot the name of it. I'm sorry. I think it's the Path to Wealth, maybe. I can look it up later.
Or is there any general advice that you would give to someone that has never invested before and they're looking to get started and they just don't really know where to begin?
Sure, you just kind of want to do your own research and kind of, if you want to work with someone or kind of do it yourself. There's, in terms of doing it yourself, there's plenty of kind of different brokerage accounts you can open. Charles Schwab, Fidelity, and Vanguard are kind of the top three, and you just open up your own account and kind of buy index funds. I would not recommend buying individual stocks as a beginner. If you want to kind of learn different kind of company and stock analysis, you're welcome to invest in individual companies, but stick to kind of ETFs and mutual funds for now. Then if you want to work with a firm or a company or a financial planning firm, I would just kind of most firms kind of schedule a complimentary consultation and just kind of talk to them about your goals and what your risk tolerance is, kind of what you have plans for the near and far future, and kind of talk about ask them what their fees are, because there's some that take about 2 to 3% of the assets under management, and some are a little bit cheaper. So just kind of shop around on what kind of firm best fits your needs, if that helps.
We have some questions regarding your personal experience in college and how you handled the 50-20, what is it, the 50-20-30 rule? Or just in general, how you worked with your finances yourself. Is that personal, or would you like to answer something about that?
No, yeah, I can talk about that. So basically I lived, sophomore through senior year of college, I lived with 3 roommates in a townhouse out in, I think, Kings Park West, that neighborhood right next to Mason. Rent was, I think, $600, so it was super cheap. I was working 4 jobs as a head coach in the summer and an assistant swim coach for kind of various teams. My kind of monthly income was, I'd say it was between 2,000 to 2,500 a month, and of 600 went to rent, and then I essentially just saved the rest of it and just kind of put it in a savings account. Limited the money on eating out and gas, and just kind of, again, overall spendings. I didn't buy any clothes. I just bought food, and I try to limit that to about 300 a month, so it'd be roughly 75 a week. Does that kind of answer the question? Or
Yeah, that answers my question perfectly. I also kind of had a follow-up, if you don't mind.
yeah, of course.
Which was, I feel like the education system kind of failed me in the aspect of understanding how to, thinking about like things like 401k or like, other things like that. And so I'm kind of wondering, do you have any resources that could be geared towards college students slash young working professionals, like books or other types of resources that we can someone like me could use to like learn more about what you've been talking about?
Sure. Let me look up that book, because I think that would help everyone. It's called The Simple Path to Wealth by J.L. Collins. That's kind of the book I'd recommend to everyone. And I can type that out in the chat. So it kind of teaches the basic benefits of investing. It gives a few scenarios of kind of different individuals and their journeys of investing. And then how I got started, I kind of am with you. I knew nothing about finance graduating college. I knew to save money, and that was it. And then just watching a bunch of YouTube videos on what stocks are, what bonds are, kind of the benefits of it, what money is, what inflation is, and kind of what really kind of helped me was how scary inflation was, and how, as you guys can see it right now, the grocery prices and movie ticket prices and gas is just crazy. It's through the roof right now. And so that's kind of what really helped me realize that, in the importance of investing, that how much our kind of the current dollar goes down in value over time. Does that help answer the question? Sorry, I kind of went off on a tangent, but
That was great. Thank you so much.
yeah, of course.
Speaking of investing, we had a question about different types of investments, specifically investments where you could lose the initial investment, or types of investments where you won't lose your initial investment.
Yeah, sure. Okay, so as you guys saw the let me go back actually to the here. So as you can kind of see, the S&P, it's up and down, but overall in kind of an upward trend. The vast majority of these funds are stock securities, which have the potential to go up and down. There's tools such as options, futures, so investing in kind of oil and commodities like that. They always have the potential to go up and down. There are also bonds, which are kind of debt instruments. Those are not guaranteed to go down, but they pay you a certain percentage of your investment, and those typically do not go down. So when the market's down, when the market's been down this year, what we've done is a lot of our clients' money we've put into treasury bonds. So those are bonds backed by the US government. So they're the closest thing to being guaranteed to any kind of security in the financial market. And they're essentially, you lend money to the government, and in turn they will pay you interest on that initial investment, and then they will pay you back that whole investment. So you're getting paid a little bit You won't get huge returns like with stocks and bonds or with stocks, but you will earn a little bit on the capital gains of it. So it just the price increasing plus that interest that they're paying you. If that does that answer it? Eating out is what gets me every time. Yeah, that's a big problem for everyone. It's hard as much as you don't or do want to eat at at Southside or Ike's. It's hard. Do those bonds offset the time value? Can you elaborate on that a little bit?
Yeah, so the initial amount of bonds that you buy over time, because what are they? What are the years that they go for? And at the end of that, when it gets paid back plus interest, and you know, the time you had mentioned the time value of money, that in the future it's not worth the same. So if I put that money in now, does it kind of like equal out in the future when those are finally due, or
Oh,
is
gotcha. Yeah.
better?
Their bonds are not like insurance products. So there's no kind of inflation adjustments to them, but there are various different lengths. You can buy a bond for that matures or that ends in a week, and it pays you, depending on your investment, it pays you just for 1 week. And once that bond matures or that bond ends, you can always kind of keep cycling through weekly or bi-weekly. They're month-long bonds, and they're also kind of yearly bonds. So you could put a bond in for 5 years, and that bond, so you put it in now, that bond matures or ends, that government will pay you back in, would that be 2028? It's a way to beat inflation because your money is making money for you, but there's no kind of inflation adjustment to those bonds, if that makes sense.
We had some questions asking a little bit more about real estate and advice for young people who are getting into buying or selling real
Okay.
estate.
In terms of having a rental property for rental income or for like purchasing a first time house, anyone can kind of elaborate on that. Well, I guess first off, if you definitely want to have a lot of kind of liquid cash sitting in the bank if you do want to invest in real estate. Depending on the area, in Nova here, it's crazy. Kind of the average townhouse can go from about $500,000 to even $1 million. So usually you'd want to put down, if it's your first time purchase, you can put down 3%. If you're using it as a rental, you have to put down 20%. And then you're finding kind of the risk of finding a tenant and the tenant being willing to pay that mortgage, if not more, for kind of rental income. So personally, I would, even though I have enough to purchase a house or put a down payment on a house, I'm waiting a little bit just because it's so kind of the housing market right now is kind of crazy, just like the securities market, if that helps. Someone asked about working or kind of young people planning for estate planning. Right now, it's if you're in your teens or 20s or 30s, it's really just investing as much as you can into that 401k, budgeting appropriately, make sure you're having as little debt as possible, and just kind of discussing with your family or a significant other, and kind of working with a planner on how much you need for retirement, how much you plan on saving, when you plan on retiring, because that's kind of a big factor of when you want to retire. I was just working with a client today, and she wants to retire today essentially, but she just doesn't have the funds. So we had to convince her she had to work for about 5 more years and then she'd be golden. But it's just kind of working out all those little details. And then how much you want to leave for any beneficiaries you have, and so forth, if that makes sense.
So if you were in kinesiology, how did you end up as a financial planner?
So I was like I said before, I was a swim coach for ever since 2016. So I was a junior in high school. And I really liked the aspect of coaching, but I wanted to kind of be a part of the corporate world. So I wanted to still kind of coach and help people plan and strategize like an athletics coach, but more in kind of a more general field where everyone needs help in terms of finances. So I wanted to help a bigger audience, if that makes sense. And then my the firm that I work for, Sovereign, our CEO is actually one of my swimmers' dad. So that's kind of how that connection came through. So yeah. Does anyone have any more questions?
Hi, I have another question. Could you elaborate on the difference between a 401k and a 403b? Because this is the first time I'm hearing of a 403b. I've literally never heard of it before.
It's literally the exact same thing, but a 403b is for nonprofit organizations, public universities, hospitals. Those generally have 403bs, so they're nonprofit. 401ks would be any for-profit company like Amazon, Tesla, or even kind of the smaller family-owned companies, if they have those kind of funds to match their employees' investments. But as long as you're matching out what your employee offers, you really don't have to worry about the difference between them.
Cool, thank you.
Yeah, sure. Someone asked how you pay for medical and dental school. Ideally, because medical professionals and dental professionals make kind of so much, you're essentially working towards that. You're gonna be in debt unless you had a crazy inheritance or something. But it's once you kind of get that big salary, once you finish all your certifications and have a full-time job, it's just kind of budgeting those first 5 to 10 years, being able to kind of just chip away at that debt. I know a lot of kind of medical students now, they're kind of looking at about $200,000 to $300,000 of debt. But when you have a $250,000 salary, it's doable within 5 years or so. It's just being very disciplined with spending, even though it's hard when you have that big salary as a start off. You kind of, the world's yours, but you tend to forget about that big debt.
If I may, my brother just finished medical school,
Okay.
and one thing I might say is if you research what school you go to, some of them offer their students a place to live. They'll pay for you to live and you won't have to get an apartment. And that can really help with
Yeah.
the situation.
Medical professionals also get, I believe it's a 10% discount on most apartments, 10 to 20. I know during COVID it was, I believe it was 50 for the apartment that I was in. So definitely take advantage of that and all the other benefits as a medical professional or a med school student in med school.
All right. Well, thank you everyone for attending. We appreciate you being here.
Yeah, thank you guys. If you guys have any questions, feel free to email me or give me a call or text me at that that number email. But yeah, again, thank you, Elle, for hosting it, and thank you guys for coming out. This